Nicole Taylor.
Stocks are flying higher today for a second straight session. Let's talk about it with a new guest. First-time guest on the WBBM Business Hour, Tim Travis, is CEO and founder of T&T Capital Management in Irvine, California. Tim, welcome to the program.
Hey, thanks for having me. I appreciate it.
Where do you see these markets headed right now?
Well, I'm pretty neutral on the overall market at this point. I think that if it's appreciated to a very reasonable level, I still think that there's pockets of just tremendous opportunity. I know you guys mentioned the banks a little earlier, but overall, I think the market's somewhat fairly valued, and I wouldn't be a huge buyer of like an index fund or anything like that right now.
Is it the earnings reports right now that are driving this recent spurt?
Well, for the financials, without a doubt, I think that that's definitely the case. And obviously, you've still got the stimulus from QE3. A lot of people are just trying to catch up, that have missed out on this rally, and so they're piling in funds, maybe at the wrong time.
So, do you see the rally kind of running out of steam here soon?
I think it could. I think that there's, areas of the market, a lot of the higher yielding dividend payers, they seem like they might be a little overvalued at this point. Talking about stocks like a Verizon, for instance, they're trading at very high multiples compared to what they normally trade at. So those are the areas of the market where I think you could see some profit taking and a little bit of a sell-off. But then there's areas like the financials, which are just significantly undervalued, even though they have appreciated recently.
So no crash coming, though.
I don't. It's impossible to predict that, of course, but 5 to 10% sell-off at some point, that's well within reason.
Well, you mentioned dividends, and dividends are very critical, especially to people who are in or near retirement, and clearly they cannot count on treasuries for income with the rates as low as they are. What are you recommending for your income-oriented clients, Tim?
Well, that's a good question. You're absolutely right. Dividends are key, but especially with the uncertainty relating to taxation, we're choosing to use a slightly different strategy. So one thing that we'll do is we'll sell a put option on a stock that we're comfortable owning anyways. So let's say that you were interested in owning, Citigroup, which doesn't pay much of a dividend. What you could do is instead of buying the stock, you could sell a put. So you could sell like the January 2014 $35 put. That's going for about $470. And so basically, if you have two options of what can happen. If the stock closes below 35, you're going to end up owning 100 shares of Citigroup at $30.30. That's your break even. So quite a bit below 37. It's a much safer way to play it. And if Citigroup closes below 35 in about just over a year, you're going to make $470 on $30.30 a share is your break even. So that's about a 15.5% return. So that's a safer way to generate income. That's the type of thing that we do.
A little sophisticated for the retail investor who is acting on his own. So what about those who are managing those own accounts and might not be that sophisticated about investing, Tim?
Yeah, I mean, you could look at, a stock like a Johnson & Johnson, which has a yield in excess of 3%. Another one is Pepsi, which has a yield, right around 3%. Those are both stocks that are trading at reasonable values with decent upside potential that I think you'll do okay on.
When the markets...
Yeah. Go ahead.
No, I was going to say, when the markets collapsed in 2008, a lot of people panicked and sold out, and we simply don't have the large number of investors that used to be prevalent in the markets. But had those investors not sold out and just held on, they might be sitting pretty today. What is your thinking about a buy and hold strategy versus trying to time the markets?
We're big advocates of buy and hold. It doesn't mean you hold on forever, but it means that you take a longer term approach. So we don't buy stocks that we're not comfortable holding for 3 to 5 years. If need be. If you need the money in less than a year, realistically, stocks aren't the right place for you to be anyways. So I definitely agree with your premise completely.
Good talking to you and meeting you, Tim. Thanks so much.
Thanks for having me. Bye.
Tim Travis is CEO and founder of T&T Capital Management in Irvine, California.
WBBM News Time.